Citizens of Japan speak Japanese, lawyers speak legalese, and leading investment advisors, casino statisticians, and insurance actuaries speak Riskese. Riskese is the essential language of investing and is used to discuss topics of risk, return, statistical significance, and time. Risk and returns go hand in hand. You can't expect high returns without taking risk. People are perfectly comfortable talking about the returns portion of the investment process, but they can become very squeamish when they realise they'll lose money on their investments.
The idea of the term Riskese came to me as I was sitting in lectures provided by academics who literally speak their own language. And they rattle off terms like correlations and standard deviations and t-statistics that they just assume their audience is aware of and they knew the definitions of. And as I looked around the room, I noticed there were a lot of people who weren't quite following these academics, and it occurred to me they have their own language. We sometimes call it academic speak. But for investors, the important part of that language is this characterization of risk. This relationship between risk and return has to do with the uncertainty of the return and then the price that a willing buyer is willing to pay based on that uncertainty. So let's assume I have an investment that we would expect to earn 10% a year, and you want to buy that from me. One of the first things you want to know is how certain is that 10%. And the more risk or uncertainty associated with that 10%, the lower the price that you would be willing to pay for that investment.
Every investment carries an expected return. The risk of an investment is quantified by the degree to which the returns of the investment deviate from the average return during specific periods of time. Higher risk investments carry a wider range of short-term outcomes, but also carry higher expected returns, compensating investors for withstanding short-term volatility. In contrast, investments that have had a narrow range of outcomes over long periods of time are expected to provide more consistent returns, with the trade-off of lower returns. For example, an all-bond index portfolio has provided a small but consistent return, while an all-equity index portfolio has provided a larger but more erratic return. Higher expected returns are the reward for an investor's willingness to accept this volatility. In other words, risk is the source of returns and should therefore be embraced in appropriate doses.
A measure of the volatility of investment returns that's most often used is standard deviation. It's a standardized measure of how much returns deviate from the average return. If we were to look at the S&P 500 over the last 87 years, we would see that the average is about 10%, but about 2/3 of the time, we see a range of 20 on the plus side and 20 on the negative side. So we like to say that the S&P has an average of 10 and a standard deviation of 20.
The concept of standard deviation is illustrated in this bell-shaped curve. The curve represents a set of outcomes. In this case, let's say the outcomes are the monthly returns of an investment. The yellow area covers one standard deviation either side of the average and accounts for approximately 68% of investment outcomes in a given period. The area within two standard deviations of the average, shaded yellow or green, accounts for 95.6% of outcomes. And the area up to 3 standard deviations away from the mean, shaded yellow, green and orange, accounts for 99.7% of all outcomes. The higher an investment's standard deviation, the greater the chance that future returns will lie farther away from the average return.
What we have here is a probability machine. The probability machine helps demonstrate randomness, sometimes called chaos up top as the beads bounce around like crazy, and the normal distribution of stock market returns. The reason that we have this machine is to use this as a tool to explain stock market randomness. So as you look in the background here, you see these red bars. Those red bars represent 600 monthly returns of a globally diversified portfolio of index funds of stocks. Okay, this is equity portfolio, right? And what you see is right down the middle is about 1% a month, and in the extreme tails are plus 15% in a month and minus 15% in a month. And about 2/3 of the time, it's plus or minus 4.5%. That's called the standard deviation.
It's also useful for investors to think in terms of the different dimensions of risk that drive investment returns. We owe our understanding of these risk dimensions principally to two academics, Eugene Farmer and Kenneth French.
The multi-factor model took the equity returns of stocks and carved them up into slices, basically looking at the size of the companies and a value growth metric. And so by dividing up the market into these slices and looking at the returns of these different slices, academics, and primarily Farmer and French, uncovered that there had been higher returns among small companies and among value companies. And then when you blended that, you even had a combination of these factors for even higher returns.
Just as there are risk dimensions with stocks, there are also different factors that drive bond returns. The term or maturity risk factor refers to the difference in returns between long-term government bonds and short-term treasury bills. Longer-term bonds are riskier than shorter-term instruments and have historically yielded higher returns. There's also the default risk factor, which is associated with the credit quality of bonds. Instruments of lower credit quality are riskier than those of higher credit quality, again yielding higher expected returns. Risk, you'll have noticed, is a very complex subject, and you don't need to be an expert to be a successful investor. However, you do need to understand the basic principles. In a nutshell, returns are the rewards for the risk an investor takes. So as well as exposing your portfolio to general market risk, it also makes sense to utilize the different dimensions of risk to maximize your returns.